for inviting me here. Following the war, the Swedish economy was facing a number of challenges. That threatened inflation, wage inequality, unemployment. So the trade unions at that time, late 40s, early 50s, they asked themselves, could they come up with a policy that could combine full employment and low inflation, strong economic growth, and relative wage equality? Now, this debate was informed by the work of two of the greatest economists of the 20th century that people have never heard of, and that is Gustav Rehn and Rudolf Meidner. They weren't heard of because they weren't academics, they weren't in think tanks, they actually worked for the Trade Union Confederation. And what came out of that was a model, sometimes called the Rehn-Meidner model, sometimes called the Swedish or the Nordic model, that focused on the productive economy, we think that the Swedish model is about tax and spend, and universal services. That was only made possible because of the focus on creating a strong, efficient economy. They did this in two ways. First off, they set up goals. And when I say they, I mean the Swedish trade union movement. I mean the trade union members. This was a debate that was occurring across the movement. So they had goals which actually are still relevant to us today. Growth, full employment, we might call it quality employment, equality, and price stability. We would obviously add, if we were doing this today, just transition, climate change, and the impact of automation and AI. And they used a handful of instruments to achieve these goals. But in keeping the number of instruments small, each one of these instruments served to actually achieve more than one goal. They served a number of goals, but more importantly, or just as importantly, if one instrument had a downside, and we're dealing with the market economy, there are going to be downsides, they then constructed another instrument that would actually address that negative impact. So the proposal of this presentation is that we likewise engage in a movement-wide debate to develop goals and instruments for a new economic model. Now, this is not a compilation of...
Quick announcement. Anybody at home, can we get you to turn off your microphones there? We just got a cough in there and people rustling around. Thank you. Sorry.
No. Now, this is not a compilation of policies. This is a long-term framework within which it would be easier to solve the policy deficits. And it's not about replicating what Rehn and Meidner or the Swedish did. That would not be possible today, even if some of it were even desirable, and some of it. But it is about using that ambition. So we're going to keep those four goals, but it's really going to mostly focus on growth, simply because of a matter of time. Although referring to the other three goals, it's going to focus on the domestically owned market economy. That's the portion of the economy that is that's the market. It excludes basically the public sector, and by focusing on domestic owned, it excludes the multinationals. I'm not saying that would be done, but it's just for the purposes of today to focus in on. Now, data should be treated as a bit indicative. It's very lumpy, it's very patchy, you have to put it kind of together. There are different ways of putting the data together. Doesn't matter which way you do it, the story remains the same. And we compare ourselves to other small open economies which have high incomes. Let's start with the first. Labor productivity is a key growth metric. Basically, it's about how much income you have, and you divide it by the number of employees, or if you have it, preferably, the number of hours worked. And as you can see, Ireland's domestic market economy, which employs over 1 million people, so I mean it's the biggest part of our labor market. As you can see, our productivity is at the bottom compared to our peer group. It would have to increase by 25% just to reach the peer group average, and by over 2/3 to reach the best in the class. Now, this can sometimes seem somewhat abstract, productivity and all that. This is the driver behind living standards, behind wages, behind tax revenue, behind actually an economy that's dynamic and innovative, and one that is not. And I'll just give you one example of that. I'm not sure, because I haven't gone through all of them. There's a lot of domestic subsectors, but I'm not sure if this is an extreme example, but it has serious implication for wages. For instance, let's take a look at the road freight haulage sector. Employs 22,000 people. Irish compensation, employee compensation is significantly below average. This is one of those things where we don't have the data per hour, which would be really useful. We just have it per employee. But as you can see, the wage level is very low compared to our peer group average. Nonetheless, but our labor share is high, which means that Irish workers are taking more of the value added than workers in other countries. Because don't forget, value added can only go two ways. You can either go to wages or you can go to profits. The more wages there are, the less profits there are. So actually, we grab more of the wages. So why is it the case that the wages are so low if they're grabbing more of the value added? Quite simply because of low productivity. 40% below the productivity of our peer group. So that even if Irish workers took 100% of value added, wiped out profits, no profits in that sector, it all goes to wages. The employers who are running the companies, they're doing it for philanthropic reasons, not for reasons because they're making a profit. Even if they were to do that, wages would still be below the EU average, simply because of a low productivity ceiling. So wages are driven by a number of factors, primarily bargaining power, but also productivity. There are further challenges. NESC, National Economic and Social Council, in the last week had a publication, and they identified similar productivity deficits in our domestic sector. They also observed that there has actually been a slowdown. Not only are we low by our peer group matter, our productivity in the domestic sector is slowing down. That value added per employee is falling. Some sectors showing negative productivity growth. And if that's not bad enough, low productivity, which is already slowing down, we work more hours. That's how we compensate our income nationally. We don't do it because our domestic sectors is a dynamic, innovative, thriving thing. It's because we just work longer. We work 4 weeks longer than the average workers in our peer group. That's how we make it up. That's a pretty high price. So if all that wasn't bad enough, we now have projections of a slowing down trend in growth over the foreseeable future. Fiscal Council, government, EU Commission, World Bank, recently the IMF, have all projected a low growth future. Aging demographics, technological pessimism, climate change, number of factors. In a few years, as you can see here, this is the Fiscal Council projections. Now, these are just projections, but they're actually not outliers. They're pretty consistent with other projections. Okay, 4% in 2025, falls to 2.1 in 2030. That's what the government said yesterday. And then it falls to 1.3 and 0.8. For 20 years, we will have an average annual growth rate of 1%. That's pretty much running to stand still. Think of the impact that would have on jobs, on wages, on the ability to finance public services, fiscal stability. But the big question is our low productivity domestic sector capable of meeting this challenge? Now, so what are the instruments to promote growth? The Swedish model, Rehn-Meidner or whatever, basic principle for firms and sectors was quite simple and quite ruthless. It was to crowd out the unproductive and to crowd in the productive. And one of the instruments they used was the solidaristic wage strategy, which was actually at that time, a highly centralized wage bargaining in Sweden. And what they did was they pursued the same rates of pay for comparable work, regardless of company profitability. We're used to the idea that you lay claims, wage claims, based on a company's profitability. No, that's not what they did. That's not the strategy they did. They linked it to productivity, and it was regardless of company profitability. If the firms couldn't pay, they were allowed to fall. That's how they crowded out the unproductive. And then their resources were directed to more productive firms and more productive sectors. Now, of course, this would risk unemployment, so they will talk about this later. They used another instrument to address that risk, labor market policies. the labor market policies. The point is this. This was a major intervention in the market that was led by the trade union movement, the strength of their bargaining power, but most importantly, seeing that it wasn't, they weren't going to allow company profitability to stand in the way. They would link it to productivity. Now, different context altogether here. We're not going to be able to do that, even if it were desirable. So what are the instruments that we could utilize to promote growth? In other words, to crowd out the unproductive and crowd in the productive. Well, obviously collective bargaining. That wasn't an issue for them. Has huge trade union decency, huge collective agreement coverage. That wasn't an issue. For us, it is. And we usually express it in terms of labor rights, which is correct. We talk about collective bargaining as a labor right. But in this context, it is about a productivity enhancing instrument. It's about growing the economy. And it can be used in the public debate to be turned on employers, those employers who obstruct collective bargaining, those politicians which obstruct collective bargaining are actually undermining economic growth. Collective bargaining is just the first rung on the productivity ladder. As you go up the ladder, employee participations that are collectively agreed, co-determination, co-management, worker directors, they all increase productivity of the firms and therefore of the economy as a whole. By the way, the National Workers Director Group, which is the group that's made up of worker directors on public enterprises, will be publishing a paper very shortly where they propose extending worker directors not only throughout the public sector, but the private sector as well. Why? Because it enhances growth and productivity. So these are instruments of growth: workplace democracy, the EU transposing the EU directive, collective labor rights. Second instrument, sectoral socialization. A bit of a mouthful there. The basis for this is already in the program for government. In the program for government, there's a commitment to establish sectoral task forces with the stakeholders, quotation marks, employers, employees, supposed to be supported by experts and chaired by the line minister. And they are supposed to assess the sectoral challenges that any particular sector faces, whether it's low productivity or investment, labor shortages, high input costs, whatever. To get an idea of what that means in terms of a sectoral analysis, the best thing that we could go to is ICTU's publication on the meat processing sector. This was an analysis that exposed a low value, low waged, low investment, low road sector. And that is the type of approach one is needed in a very robust way to look at the various sectors that we would seek to socialize through these sectoral task forces. Because they are needed not just to boost sector-wide productivity, but to prepare for a just transition and deal with the restructuring of unproductive sectors. And we'll come to that in a minute. So this is about a negotiated economy rather than a free-for-all. It is about a permanent social deepening of labor into the decision-making process at sectoral level. Third instrument, again, the Rehn-Meidner model the Swedish model used marginal employment subsidies to reward and incentivize productive companies. Marginal employment subsidies are basically, they actually subsidize additional employment, any additional employment that firms made. Now, there was about a criteria for that that kept in line in terms of, did it reach a certain productivity level? Well, we could look at that, but we could also reform our own business subsidy regime to incentivize productive companies and sectors. And given that there's over 40 public agencies that subsidize the private sector, there's a lot that we could work within. Now, this would mean prioritizing access to grant funding and public procurement to those companies that possess a good company seal. The European Trade Union Institute uses the term sustainable companies, so a sustainable company seal. In other words, a seal of approval. Have that met the criteria to achieve this? Now, that means that we have to establish and put forward what are the components of a good company. Okay, labor rights, investment over value extraction. over, dividends or share buybacks, financial transparency, environmental measures, on and on. There are any range of benchmarks. But a valuable tool in the public debate over what constitutes a good company is negative externality. It's kind of doesn't really flow off the tongue, but negative externality occurs when a company maximizes its profits by imposing or externalizing costs onto other parties that are to other parties. For example, a company engaged in low pay and exploitative conditions to boost its profits increases the costs to other sectors. First off, it obviously increases the cost to the workers to reduce living standard. Secondly, reduces the cost to the state in terms of lower tax revenue and higher social protection subsidies. But third, and this doesn't get mentioned that much, it actually imposes costs on other businesses, and the employees in that, which are reliant upon the spending power of those domestic workers who are paying the cost, the negative cost of which that company is imposing. Let's be clear. We cannot afford to publicly subsidize companies that incur high negative externalities, subsidize unproductive or inefficient firms. That must be, to my mind, a bottom line, because the point of policy must be to privilege companies and economic activity which has positive externalities, positive as opposed to negative. The fourth one, a little bit difficult to grasp this because we don't actually do this much, is restructuring, sectoral restructuring. Give you an idea, hospitality. 16% of all employees in the domestic market economy work in hospitality. That is a much larger proportion than other countries. Now you say, well, it's because we have a high level of tourism. Well, actually, no, we don't. Netherlands has a higher level of tourism than we do. Austria has a much higher level of tourism than we do, and they have significantly lower proportion of workers. 1 in 6 workers in the domestic market economy works in hospitality. This is a notoriously low productivity sector. Whereas the domestic economy generates 50,000 euros per employee, hospitality is only 18. What we need to do is transfer, resize, if you will, and transfer resources away from hospitality towards more productive sectors, which can boost overall economic performance, but also give us time to focus on the pay and working conditions in what is a rationalized hospitality sector. The labor market policies. This was an absolutely necessary instrument in the Swedish model. They could not have done what they did without an active labor market policies. That's the ALMP. It incorporated supply side measures such as relocation, retraining grants, occupational training programs, public employment services to adjust job applicants to new vacancies, strong unemployment benefits that protected incomes while people seek new jobs or participate in training. A positive for the household, but also a positive for the economy. I think Kieran has done work on mismatch of skills of workers, and the rationale behind a very lengthy period of protected incomes was to allow people to make sure that their skills matched their job and there wasn't a mismatch of skills. Without these strong labor market policies, there could have been no crowding in or crowding out. Now, Irish expenditure on labor market policies is pretty poor. Well, as you see there, it's at the bottom of the table. We do a lot of resting at the bottom of the table in these measurements. Now, you might say that, well, Sweden doesn't look a whole lot better. It's all this about labor market policies. The thing is that their job security councils are not funded by the state. They're funded by collective agreement between the employers and employees. And they are comprehensive retraining and citing of workers in vacancies. And it's considered one of the best in the EU, Job Security Council. Nearly 90% of those made unemployed are placed in a job within 8 months, the majority with either the same or higher pay. Okay. So this is part of such programs are needed to meet restructuring sectors, but were also needed to meet just transition. Now, what if, after all this was introduced, what if that we still cannot generate the quality economic activity in our domestic economy? In other words, the domestic bourgeoisie in many sectors are not up to the task. Well, there's a few things we can do. One, we can update the definition of market failure. Market failure was the rationale for establishing public enterprises, where private capital couldn't or wouldn't invest. Hence, we have ESB, we had Aer Lingus, we had a whole range of ICC and ACC, don't have them anymore, but that was the rationale because there was a market failure. We should update this where private capital can't or won't finance the critical activity to meet our goals. And in that respect, we should, update ICTU's state holding company policy, which was published before the crash, to promote more market enterprise activity through public enterprises. But not just that, public sector-led enterprises, equity financing of new and expanding companies, co-equity partnerships, all with firms with a good company seal, promote other enterprise forms, civil society enterprises, labor-led, labor-managed enterprises, nonprofit, community-owned initiatives. Here is an opportunity for trade unionists to argue for enterprise pluralism and enterprise expansion. That puts us at the heart of the debate over productivity and efficiency. I'm going to go through the other three goals real quick and then come to a conclusion. Second goal that was established by the Swedish trade union movement was full employment. We might call it full quality employment. Unemployment is below 5%. It's reckoned to stay below 5% for the next 5-6 years. Hopefully it does. But it's about more than a low unemployment rate. Over 200,000 people who want to work are not counted in the unemployment data because while they want to work, they are not currently seeking employment. And some of the reasons why cut to the heart of state provision. For instance, a substantial number are not seeking employment because they are care of a disabled adult or child, or they are themselves suffering from disability. So that's the first thing. There's a considerable body of people who want to work if given the opportunity to work, which could, of course, labor force participation drives economic growth. It can help address the labor shortages. The debate over employment quality. Well, to my mind, that debate is over. All we have to do is measure it, because the EU Parliament have laid down very clear criteria over how we judge employment quality. Low pay, collective labor rights, access to social insurance, the nature of the contract, career development and training, stress and health. Actually, NERI did a study that found in 2016, using some of these criteria, that between 500 and 800,000 workers in the economy were working in sub-quality, if you will, or precarious jobs. That's the extent of employment quality. Again, what are the instruments for quality employment? Well, again, collective labor rights, that can help solve some of the problems in terms of employment quality at the firm or even sectoral level. Public services become so important because they can provide the public service that will free up people to join the labor force and address labor shortages and enhance incomes. Two small, relatively small examples, but key, and will be growing in the future: childcare and especially elder care. To invest in those services is an investment in the productive economy. Sectoral socialization and a good company seal addresses quality of employment, again, at firm and sectoral level. And sectoral restructuring, just with the example of hospitality, you're moving people, you're retraining, you're moving re-skilled labor to more productive sectors, which are likely to have better working conditions than in the hospitality sector. The third goal is equality. And in the market economy, equality starts in the workplace. It starts in the world of production. That's where equality starts. Different ways to measure equality. Earnings differential, gender pay gap, low pay, in-work benefits. There's a number of that. Just cut to the bottom line here. Again, we feature at the bottom of all those tables. If you were to put up the tables, I'm not going to bore you because it would just be a blur, but you can always see the green strip at the bottom. But here's the interesting thing about the debate over equality. Every once in a while, it flares up. And I think there's a couple of you people here have been involved in those kind of debates in social media. I think Karen has kind of gotten his 2 feet stuck in on that, where somebody says, is Ireland becoming more or less equal? And of course, they only look at the household level. And the debate is so weird. I mean, people are parsing the data up to the third decimal point. No one cares to look at, well, look at equality in the market economy. There, what do we find? We are becoming an ever more unequal society. Back in 2000, 60% of value went to wages, value added, 40% to profits. Now it's nearly an even split. There is a continuous line of profits grabbing more and more share. So look at it this way. We have low productivity. Our productivity is falling. We work more hours than anybody else in the friggin' EU. And now what little productivity is being produced, profits are gobbling up more and more of it. That's the story. That's the story here. Again, instruments for equality. There's a range of them that can address the income inequality. But equality is also about more than just income. Again, public services providing free or affordable services that would otherwise have to be bought in the private market, and they ration by the basis of price, and if you can't pay it, you have to do without. That's how that's done. Also, though, it is a key driver in infrastructural investment. We usually think of infrastructural investment as physical capital. And that's true. It's important. Machinery, equipment, roads, energy infrastructure, buildings. But infrastructural investment also involves human capital investment. Investment, which is usually measured by educational expenditure and by our spending on R&D. And again, Ireland falls at the bottom of the table. To give you an idea, we would have to increase spending on education from pre-primary all the way up to third level by about €2.5 billion just to reach our peer group average. You don't even want to know how much we'd have to spend to get to the best in the class. R&D spending across government, business, and higher education would have to increase by $1.5 billion. Quite simply, it's not just about shortchanging children, which we're doing in bucket loads. It's about shortchanging our future. That's what that effect has. It actually reduces future growth in the future. Social wage. I don't know what I was thinking. I said a significant number here. A majority of workers in the domestic market economy do not have access to occupational pension, a strong sick pay scheme, maternity and paternity benefit top-ups, or generous family leave. This can be addressed through social insurance, PRSI, because social insurance spreads or socializes the cost of strong in-work benefits throughout all sectors, throughout all enterprises, so that all workers benefit. Now, the last one, price stability. I'm going to just explain it and then show why this is a real, sorry? 2 or 3 minutes. Okay, I'm going to fly here. You can see here in 1995, we were below the EU average in terms of prices, living costs. By last year, 2 years ago, we were the highest. Look at that growth in living costs. Now, Denmark used to be the highest. It was always very high, and it was stable. All the other countries stable. We, however, have increased substantially. The problem with trying to address this is that they become embedded in the economy. They become embedded in the enterprise price structure, embedded in household costs. And there is no example of an EU country significantly reducing its living costs over any period of time. So that will be a difficult thing to do. Because of time, I won't go through it. You have the PowerPoint. You can see which are at least the household consumption categories. There's also business inputs that have to be considered, which are higher than even our high average. There's one positive, which might give us some kind of way through the darkness. While fuel and food prices increased by double digits over the last year, bus fares went down by 35%. Childcare went down by 22%, and this was due to public services expenditure. In other words, there is a way to influence some prices. How many categories is something to be investigated. So these are all the different instruments. These are the impact on goals. They all impact on more than one goal. This is actually a visual description of what the Rehn-Meidner or the Swedish model did. You can see the 4 goals in between. You got all the instruments going there. You got lines going all over, nearly like a Jackson Pollock thing. By the way, that's not what they started out with. They didn't start model building. It was a pragmatic approach to problems as they confronted them and things that they evolved. In fact, the person who designed this description of the Rehn-Meidner model was Leonard Eriksson, who actually spoke at a NERI seminar here 10 years ago on the Rehn-Meidner plan. So how can we take charge of the debate? Well, look at it this way. I haven't mentioned anything about the goal of just transition, either climate change or automation. Haven't discussed fiscal policy. Thankfully, you get these things. Oh, next up, we're going to have a discussion on the economy. And what is it? The first question, do you think there should be tax cuts? You know, do we think we should spend more money on this and all that? I hope you've gotten an appreciation of the fact that fiscal capacity depends on productive capacity. In other words, or put it another way, poor productivity equals a poor budget. Haven't discussed FDI and multinationals or public sector employee-driven productivity, which is needed if we're going to argue for increased that. So, very quickly, 6 points. Describe the situation. That's how first we can start taking charge of the debate. Those who actually are the first to come in and describe the situation tend to lead the debate because they describe it in the way that the resolutions flow out of it. Develop a small number of goals and instruments. If you've got 20 goals and 25 instruments, you've got nothing. You've got a large document which is fit only for the archives. Embed the discussion among trade union members and activists. Process is important as product. Highlight good practice. Highlight those companies and those sectors that are actually that can act as a model for what we want to achieve. Develop our own resources and expertise, whether that's research, whether that's communication within the trade union movement to facilitate this movement-wide discussion. But mostly of all, and just finishing this, politicize the issues, for these are not technocratic issues. This is about organized labor intervening, directing, and leading the debate. It is a cultural struggle over ideas. To sum it up, business in Ireland is too important to be left to Irish business. Thank you.